Something big is coming in UK tax that's going to touch pretty much every single business. Today, we've teamed up with the experts at ProTax Accountant to unpack HMRC's new climate change levy changes and figure out what on earth they actually mean for you. Let me just cut to the chase. Yes, they almost certainly will. The real question isn't if your costs are going to go up, but by how much, and if you're ready for it. This isn't just some tiny tweak in the budget. It's a major policy shift you need to get ahead of, starting right now. So what's all the fuss about? Well, a really key business tax, the climate change levy, is getting a massive shakeup. Over the next few minutes, we're going to break down exactly what's changing, why it's happening, and most importantly, what it means for your company's bottom line.
All right, here's our game plan. First, we'll get you up to speed on the basics of the climate change levy. Then we'll dive into the really crucial bit, the new rates for 2026. We're going to look at a pretty cool case study on hydrogen to see how this tax is trying to evolve. After that, we'll do the math on what this means for a real small business, lay out a plan so you can prepare, and then talk about why getting expert advice is so vital.
Okay, so let's start at the very beginning. What exactly is the climate change levy, or CCL? It might sound complicated, but honestly, what it does is pretty straightforward. At its heart, the CCL is just a tax on the energy that businesses use, so your electricity, your gas, and other fuels. If you run a business in the UK, chances are you're already paying it on your energy bills. You might not have even noticed. This isn't a tax for households, it's strictly for businesses and the public sector. And the reason for it, well, the clue is in the name, right? The government brought this in way back in 2001 to basically give businesses a little nudge, or maybe a shove, to be more energy efficient. By making energy a bit more expensive, the idea is to get you thinking about investing in greener tech and just being smarter with your energy use. Okay, now for the part you've really been waiting for, the new numbers. This is where it gets real for your business planning. Now, this next part is absolutely crucial for every business owner, so stay with me. These new rates are a huge signal of where the government is heading. First up, electricity. From April 2026, the main CCL rate for electricity is going to be 0.00801 pounds per kilowatt hour. Now that's a small bump up, but it's what's coming next that's the real story here. And here it is, the big one. The main rate for natural gas will also be 0.00801 per kilowatt hour. That's right. They're making the tax on gas and electricity exactly the same. This is a massive change, and it's completely intentional. And just to round it out, for businesses that use liquefied petroleum gas, or LPG, the rate is staying put. It'll be 0.02175 per kilogram. So no big surprise there. The real shocker is when you put the old gas rate and the new one side by side. This chart just lays it all out, crystal clear. Look, the electricity rate is going up by about 3.4%, which is fairly standard. But then look at gas. It's jumping by a staggering 19.2%. And no, that is not a typo. It's a very deliberate move from HMRC. And here's a little pro tip for you, straight from the folks at ProTax Accountant. For years, gas has been taxed at a much lower rate than electricity. By yanking the gas rate up to match electricity, the government is shouting a clear message. We want you to stop using gas. They're removing the tax advantage and trying to push businesses towards electrifying everything. Now, this whole policy shift isn't happening in a bubble. The energy world is changing incredibly fast, and the tax system is basically scrambling to keep up. Let's look at a fascinating example of this in action, the whole hydrogen puzzle. So, think about this for a second. How do you tax the energy that's used to make other forms of clean energy? For instance, you make something called electrolytic hydrogen by zapping water with a ton of electricity. Well, if your whole goal is to encourage green energy, it doesn't make much sense to then slap a huge tax on the electricity used to create it, does it? HMRC has been thinking really hard about this. It really came down to two main options. Option A was kind of the quick and dirty fix. Just add hydrogen production to a list of things that are already exempt from the tax. Simple. Option B was the more, let's do this properly approach. Create a brand new, broader exemption for any energy used to make hydrogen. That's more future-proof. And honestly, businesses were split, which just shows you how tricky this is. And look, this isn't just a bunch of people in suits debating things. This quote from a real UK business says it all. They're basically saying, if you can't tell us for certain what the tax is going to be,
We can't justify spending millions of pounds on this new green technology. It just goes to show you how tax policy can literally make or break the future of green energy.
Okay, so we've talked policy, we've talked future tech, but what does all this actually mean for your business finances? Right now, let's get practical and break it down with a simple, real-world example. So, let me introduce you to Sarah. She runs a great little manufacturing workshop up in Sheffield. And like a lot of businesses her size, she relies on natural gas for heating and some of her machinery. She's on top of her finances, but this CCL change is about to give her a nasty surprise.
All right, let's do the math together. Her workshop uses about 200,000 kilowatt hours of gas a year. Right now, in 2025, the CCL portion of that costs her £1,344. But come 2026, with the new rate, that exact same amount of gas is going to cost her £1,602 in tax. That's an extra £258 a year. Now, it might not sound like the end of the world, but that's a 19.2% hike on that specific cost, and that money has to come from somewhere.
Okay, seeing numbers like that can be a bit of a shock. I get it. But here's the good news. You have time to get ready. The absolute key is to be proactive, not reactive. So let's stop talking about the problem and start talking about the solution. Here's a simple 4-step action plan you can start on today. First, audit. Get out your old energy bills and figure out exactly what you're using and what you're paying in CCCL right now. Second, investigate. Start looking into energy-saving upgrades and, crucially, see if you qualify for any tax reliefs. Third, budget. Plug these new rates into your spreadsheet and see exactly what the damage is going to be in 2026. And finally, and this is probably the most important, get advice. This stuff is complex, and a good advisor is worth their weight in gold. And that brings us to our final and maybe most critical point. Trying to navigate these kinds of tax changes all by yourself is a really, really bad idea. Getting it wrong can cost you a fortune, but getting it right can actually save you money and give you a huge strategic advantage. So I'm going to leave you with this question. I want you to ask yourself right now, looking at your business today, are you really prepared for this tax hike? And are you thinking about the bigger picture, about where all of this is heading? Because let me tell you, this is just the beginning. If you're feeling a bit overwhelmed by all this, or you just want to build a solid plan to handle these changes, the experts at Pro Tax Accountant are the people to talk to. You can reach them on WhatsApp or by phone at 7985689912, or just drop them an email at info@protaxaccountant.co.uk. And just a quick disclaimer, the information we've shared today is for general guidance. It should not be the only thing you rely on to make financial decisions. It's so important that you consult with a qualified tax expert like the team at Pro Tax Accountant before you do anything. Thanks for sticking with me for this breakdown.